Voice of the Cayman Islands.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. The Chamber Pension Plan is asking for all members to ensure their member details and contact information is correct and up to date. To review and update member details, simply visit chamberpension.ky. Log into your account and provide the necessary information for your personal profile and for your beneficiaries. For assistance in updating member details, call us at 745-7630 or email admin@pensions.ky. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Money Sense, bringing an informed financial perspective to the Cayman community.
A week ago at Apple's Worldwide Developer Conference, they announced the release of Apple Vision Pro, a $3,500 headset, goggle, virtual reality, augmented reality, who knows what it is, entrance into the Matrix. You may have heard about something similar about 19 months earlier from Facebook. We're going to discuss that announcement, not so much in what this new Matrix-like world may be, but because a book written 30 years ago predicted exactly this metaverse that is taking place right now. What else did they predict? They were writing about the early 21st century. They predicted high rates of inflation, hyper rates of inflation, the attack of a virus, and they invented the name Metaverse. Incredible. It was written 30 years ago. The book is called Snow Crash, and we're going to talk about that in the second half of this 30-minute sprint of Money Sense. In the first part, we're going to talk about something more mundane, the Federal Reserve raising interest rates because it affects us all, the amount of money that we're being paid on our deposit accounts and our mortgage expenses. The Federal Reserve, is it going to continue raising interest rates or not? What's happening in the global economy? That's going to be the first half of this show. What is this show? Money Sense. My name is Emil Kalinowski, and I'm broadcasting to you live from the studios of Radio Cayman on 89.9 in Grand Cayman, 93.9 in Cayman Brac, Little Cayman, and of course as well on YouTube, on the YouTube Radio Cayman channel. Let's talk about the more mundane Federal Reserve instead of exciting stuff like science fiction predictions that come true. Well, the high priests of America's monetary technocracy held a conclave yesterday. They got together, they examined chicken guts, they stirred the chicken guts, they read tea leaves. What kind of tea? I'm guessing chocolate mint tea, maybe Kama Sutra chai, Egyptian chamomile. Let's see, Margaret's Hope black tea. One of my favorite is, of course, peppermint williamette. Who knows what kind of tea leaves they were reading? But they looked into those tea leaves, they stirred those chicken guts, and they came up with a prediction that they do not need to raise interest rates at this time. Now, this is their very first pause, the first so-called pause after 10 consecutive meetings where they have raised rates from the floor or thereabouts to where they're around right now, a little bit over 5%. This, of course, affects us and the global economy because the higher interest rates go, the higher cost of debt is, and perhaps that will be difficult for parties that are perhaps not earning as much money as they can in this global economy to be able to repay the debts, and that may lead to economic troubles. Now, we have seen something similar taking place around the Anglosphere. Other central banks have paused, but have they restarted? Let's go down to Australia, where on June 5th, they announced a surprise increase. People were expecting a pause, but they increased because they felt that inflation rates were too high. Canada, some people call it, Canada was not raising interest rates, their policy rates, since January. Then they surprised everyone 2 days after Australia's surprise by raising interest rates. Today, in Europe, Christine Lagarde is meeting with her monetary technocracy, and they're going to likely raise their policy rates as well. So we seem to be in some sort of strange medium, strange inflection point where some countries are pausing, others had paused, now they've restarted. Other countries said they were going to pause, but are raising rates. What is going on? Well, they're looking at several things. I would say two things. What state is the global economy in? And what are the rates of inflation right now? Let's talk about the rate of inflation in the United States. Not because the United States is the entire world, but because our banks here in Grand Cayman and Little Cayman and Cayman Brac take their lead from rates set in the United States on our mortgage rates, let's say, for example. So, inflation rates in the United States, this is one of two, let's say, variables that the Federal Reserve is looking at. What are inflation rates right now? Well, they seem to be relatively high compared to the last 20 years, but where are they going in the future? Believe it or not, there are estimates of where they may be going. One particular way of determining where they may be going is to ask people, dear people, where do you think they're going? There's several surveys out there. One of those is called the University of Michigan survey, and they ask, where do you believe inflation rates will be 1 year from now and 5 years from now? The latest survey from Michigan believes that interest rates will be falling on the year ahead basis. Now, they're still relatively high at 4.1%. This is much higher than anything we've seen essentially since the late 1980s. Sure, there have been spikes, but this is the longest persistent increase in expectations at this level that we have seen since the 1980s. It makes sense because of everything that's happened in the last 3 years in terms of the COVID lockdowns destroying or shocking the logistical supply chains of the world, as well as the war in Ukraine and Russia, throwing energy and food prices into the sky. So that's the 1 year expectation. It is coming down, but it is elevated relative to history. What about the 5 year expectation? This is the interesting thing. Right now it is at 2.7 according to the University of Michigan survey. Well, 3.1, forgive me. 3.1 is the latest forecast, and that is it is higher than what we saw between 2014 and 2019, but it is really no different than what we have seen since the late 90s. So over the long term, the people in the United States feel there's not much difference over the next 5 years. There's another survey from the New York Federal Reserve. They also ask 1 year and 5 year, but they also ask, well, what do you think about the next 3 years? Same thing. The New York Fed is coming up with a forecast that the inflation over the next year will be lower. Over the next 3 and 5 years, approximately the same. Not much change, maybe a little bit higher by 1/10 of a basis point relative to where the survey was last month. But the big picture is, like the University of Michigan survey, the long-term survey, the long-term outlook is unchanged relative to recent history. And the New York Federal Reserve history goes back to 2014, which is shorter than the University of Michigan survey, which goes all the way back to the late 1970s. But both of them are saying over the long term, we expect inflation rates to be not much different than what we have seen historically. What we're experiencing right now is an aberration, they are saying. I'm going to come back to that in the second half of the show. While I agree that there is an aberration we're living through, it does seem that the world has changed as predicted in Snow Crash, though perhaps not as to the degree as predicted in Snow Crash, that suggests that inflation rates in the future will be higher. How much higher? We will find out. There are other inflation expectation surveys around the world. As far as I can tell, there's at least 20 countries that report what their consumers expect inflation will be in the year ahead, plus the euro area, which is another 20 countries right there. So you've got 40 countries. At the high end, the latest survey, Argentina. Over the next year, they expect 100% rate of inflation. Russia is second, 11%. Then India, 10%. In advanced economy countries, the leaders are Sweden, 7%, and Canada at 6%. At the other end, we've got New Zealand and Switzerland down around 2%. But we're looking at the long term here. Is there anything that can tell us about the long-term inflation expectations? 1 year ahead, still elevated, but long-term, there are markets that can tell us exactly what we should expect. Whether or not it comes to pass, we don't know, but there are lots of dollars, yens, and euros, and pounds that are being bet on what inflation rates will be over the next 10 years. And what do those surveys tell us? Well, in the United States, these market-based inflation expectations, they're not really surveys like the consumers, but they're surveys of the market. And if you want to participate in the survey, you have to put up some amount of money, so you have skin in the game. In the United States, since 2007, all the way leading up to COVID, inflation expectations were just 2%. Now, 2.2% for the next 10 years. So again, long-term inflation expectations not that high compared to history, and lower than the COVID shocks that we've experienced over the last couple of years. Other countries, though, are significantly higher. The United Kingdom previously was expecting just 3%. Now they're over 3.5%. France, Italy, Germany likewise have significant increases in their 10-year expectations, but they're between 2.3 and 2.7%. Canada, interestingly, unchanged. The 10 years leading up to COVID, 1.8%, and now their forecast is again still at 1.8%. So inflation expectations, how would we summarize what we've seen in America and around the world? We could say next year, high. Next 3 to 5 years, a little bit higher than what we had experienced in the decade prior to the shocks of the COVID and the shutdowns. But that's not the only thing that's concerning the Federal Reserve when it comes to raising interest rates. It's also the state of the economy. What state is the U.S. economy in? It seems to be heading towards a recession. There are a number of indicators, ladies and gentlemen, out there that tell us whether or not a country's about to enter a recession. And many of those indicators have been studied over decades by academics. The best predictor is the yield curve. I won't be able to get into the details right now, but basically it is the bond market. And the bond market is inverted, which means it's underwater in the United States. And if you're going to be participating in this week's Flower Sea Swim on Saturday, where you have to swim for 1 mile, do you want to be underwater? No, not for 1 mile. Same thing with the bond market. You do not want to be underwater. It suggests there's trouble ahead. The economy is going to be gasping for breath. In the United States and 8 other countries, there is an inversion that is taking place in the bond market. Now, we will continue the rest of this story regarding where the economy is right now, not just in the United States, but China, Europe, and Japan very quickly, to get a sense of where we are heading with interest rates, where the Federal Reserve may go next. And then we're going to tie it back to that book that predicted the metaverse, predicted the virtual reality, viruses in the early 21st century, inflation, but they got one thing wrong, and that is the state of globalization. We're going to talk about all of that in 1 minute.
The Cayman Islands Chamber of Commerce Pension Plan. Become a member today. With 6 flexible life cycle funds, we help you plan for financial security in retirement. We keep our members informed with the plan's performance through quarterly fund fact sheets. We have an all-in expense ratio of 0.75%, over 16,000 members, and 337 million CI dollars in assets under management. If you would like to join or require further information, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. Become a member today.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Welcome back, everyone. My name is Emil Kalinowski, and today we're discussing where interest rates may be going. This was all brought about because yesterday the Federal Reserve decided to pause their interest rate hike cycle, and also 31 years ago, a book called Snow Crash was published that predicted exactly what was going to be happening in the early 21st century. All right, well, not exactly, but quite a lot. And we're going to get back to that in a second. But we were reviewing why might the Federal Reserve pause their interest rate hiking cycle, inflation. We concluded that the near-term expectations of both consumers and markets is that inflation will be a little bit high in the year ahead, but in the 5-year, 3-year, and 10-year outlook, not much higher than what we were experiencing before the coronavirus and the lockdowns. Then we started talking about the economy. What state is the economy in? If it's in a lousy state, the Federal Reserve will start cutting interest rates. So inflation rates are high, they will keep interest rates high. But if the economy is in a lousy place, they will start cutting them. How can we determine what the future holds, besides reading sci-fi books from 30 years ago? Well, we can look to the bond market. The bond market in the United States and 8 other countries, at least, is inverted, meaning it's underwater. This has been a fantastic indicator, unparalleled in its predictive ability in suggesting a recession is coming to the United States and worldwide. In the United States, there are other leading indicators, such as the Conference Board Leading Economic Indicator. What a terrible name. They could have come up with a better name than that. It has delivered 13 consecutive declines, and it has been indicating recession since the beginning of the year. There's another indicator called the Brave Butters Kelly. This is much better named indicator. Brave Butters Kelly suggests like it might be delicious, suggests like it might be some sort of an adventure, some sort of bravery is required. But actually, it's just everyone's last name, the economist's last name. Their indicator predicted recession in November and December of last year. Most recently, perhaps the easiest measure, the one that is most visceral for all of us to see if there is something wrong, is the unemployment rate. The unemployment rate went from 3.4% in the United States to 3.7%. From 3.4% in April to 3.7% in May. Both of those numbers are exceedingly low, hard to believe, but they're so low. They're so low. So how could they be indicating recession? It's that difference, ladies and gentlemen. The 0.3% difference has historically been associated with the onset of recession. So even though the number is very low, because unemployment is a lagging indicator, unlike the Conference Board's leading economic indicator, unemployment rates are lagging. Nevertheless, once you see a 0.3% increase in the unemployment rate, that is associated with recession. So the United States very likely is going to be in a recession soon, and/or already is in one. That suggests the Federal Reserve will be cutting rates. What about the rest of the world? The euro area is in a recession. It just reported its, well, let me see here. The euro area or the European Union? Yes, it was the euro area. Gosh, ladies, yes, the euro area reported its second consecutive negative quarter-on-quarter growth rate. The European Union escaped recession because it reported growth, quote unquote, of 0.1% after a negative quarter the previous ending in December. The United Kingdom has delivered 2 consecutive periods of growth, quarters of growth of 0.1%. That is stagnation, ladies and gentlemen. That's not really growth. So Europe is struggling. Japan, mixed news. And I'm bringing up Europe and Japan, and I'm about to bring up China because it's a global economy. We're synchronized. If things are not going well in Europe, if they're not going well in Japan and China, it's not going to be going well in the United States. The Federal Reserve will react, cut interest rates, and that'll affect us here in the Cayman Islands. Japan seems to be the lone bright spot, and by that I mean their data is mixed, not necessarily bright. They have a number of leading indicators. For example, machine tool orders. Those are terrible. But the Tankan index, that is very good. The leading economic index, going up. Economic Watchers survey outlook, great, improving. Their composite purchasing manager indice review survey, also going up. So they've got several indicators that are positive and improving, and a couple that are not great. So it's uncertain. But they seem to be doing better than Europe, which is stagnant and or in a recession, and the United States, which is surely in recession. Who are they also doing better than? China. Yowza. Today is the 15th of June, and this morning, very early hour morning, China reported how they were doing in terms of industrial production, construction, which they call fixed asset investment, and retail sales. I can't read Chinese, but the translation here is dreadful. That's the dreadful. The report was below already low consensus numbers across the board. So the numbers were weak sauce. Economists expected very weak sauce, and they came in even weaker out of China. China's struggling. Japan is mixed. Europe is in recession, stagnant. The United States is into or about to enter or is in trouble with recession as well. So that suggests the Federal Reserve will be cutting rates. Perhaps, ladies and gentlemen, you have noticed that we're getting mixed messages. On the one hand, we have inflation that's too high in the near term. On the other hand, we have economic data in the United States and from around the world that suggests the economy is in trouble. And that is why they paused, ladies and gentlemen. They don't know what to do. They don't know what to do. The signals are mixed, and they're going to wait and see how the dust settles over the next couple of months before they make another decision. Let us go back now to how I opened the show discussing Snow Crash, a novel that predicted the Metaverse. Facebook named itself Metaverse. Actually, they just went with Meta. I guess they couldn't afford the verse part. They trademarked. But yes, the term Metaverse was invented or come up with 30 years ago by Neil Stephenson in his book Snow Crash, in which he predicted that the early 21st century would be filled with hyperinflation, lurid wealth inequality, a virus stalking these societies, as well as a matrix-like virtual reality. And so this book was published 31 years ago, and last year it was celebrated in the press. People said, oh, it's so prescient, wonderful. One thing that it wrote about was about globalization and how it would continue. And that is just the one area that it got wrong so far. I'm reading the book, so I don't know. I'll let you know next time I come up what else it may have gotten wrong. But let me just read a little bit. And it's a little bit spicy for the morning, but I'm going to bleep out any expletive. Here's what they're writing about. Here's what it is. Quote, "This is America. People do whatever the expletive they feel like doing. You got a problem with that? Because they have a right to, and because they have guns and no one can bleep stop them. As a result, this country has one of the worst economies in the world." Pretty funny. Here's a little bit more where the author explains how globalization would end up if it continued on the path it was on. And that path at that time, the post-Cold War globalization, was only 1 year old. The book was written in 92. The post-Cold War globalization had started in 1991, and this author was prescient enough to see what was coming. And here's how he described it, even though this is not what came to pass. Quote, "When it gets down to it, talking trade balances here, once we've brain drained all our technology into other countries, when things have evened out, like they're making cars in Bolivia and microwave ovens in Tajikistan and selling them here, once our edge in natural resources has been made irrelevant by giant Hong Kong ships and dirigibles that can ship North Dakota all the way to New Zealand for a nickel, once the invisible hand, capitalism, has taken all those historical inequities and smeared them out into a broad global layer of what a Pakistani brickmaker would consider to be prosperity, you know what? There are only 4 things we, Americans, do better than anyone else: music, movies, microcode, and high-speed pizza delivery." The high-speed pizza delivery is hilarious. There's a scene that takes place right after this that is fabulous. I can't wait for them to make a movie out of that scene. But the point was, besides the comedy in there, was that globalization evens everything out on a global basis. And it brings people in advanced economies to a state of being where their economy stinks compared to what they were experiencing before. Whereas people in emerging markets are happy. They've now achieved prosperity relative to where they were. Now, if we were all part of one human fraternity, perhaps still in the Garden of Eden, then this would be perfectly fine and we would be happy and at peace with this. But as we got kicked out of the Garden of Eden, people in the advanced economies don't particularly take kindly to their wealth being slowly siphoned away. And eventually what happens is there's a counter reaction to globalization, and globalization stops. It is not a linear process. And you can see this in the most recently reported data for world merchandise trade. China, in March, had an incredible month, and they exported 20% more in March than they did in February. This was one of the best gains they've had ever. It was the second largest gain they've had in 33 years. Fabulous, right? Yet if you take a look at total merchandise trade, it only grew by 0.2%. And it was only the first month in 4 that was positive. If you take a wider look at it, you would see that merchandise trade and globalization had stopped some 15 years ago, and it's only stagnated since. Why? Because we were on a path whereby the world was, what would we call it? It was becoming less unequal. And the people in advanced economies felt that this was not going to, they didn't want this to continue. And it went wrong with some fraud in the mortgage-backed security markets, the global financial crisis, many more since then. And the consequences are that Snow Crash predicted many things correctly, but globalization continuing was not one of them. And now we are moving towards a world where investors face a stark choice. Are they on the side of the US or China? Because now there's a great power competition. And that will mean we are moving towards an era where we are not focusing, we are not emphasizing efficiency, cost savings in our goods and services, but resiliency. That means things are going to cost more, but we will be resilient. If they cost more, inflation rates will be higher. So in the future, yes, there will be higher rates of inflation. They will be higher rates of inflation because we are deglobalizing. Well, ladies and gentlemen, my time has run out, unfortunately. I'd love to talk to you more, but that's where we are in the state of things. The global economy heading towards a recession. Likely the central banks will be cutting rates in the near future, hopefully, because we're entering some sort of downturn. But at the same time, there is this underlying push towards higher rates of inflation over the next decade or so. Ladies and gentlemen, we're going to be talking about much more in the next show, which is 2 weeks from now. So I can't wait to hear from all of you next time we're on the air. Thank you very much for having me.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit
The Cayman Islands Chamber of Commerce
chamberpension.ky.
Pension Plan. We're here for you. The Chamber Pension Plan is asking for all members to ensure their member details and contact information is correct and up to date. To review and update member details, simply visit chamberpension.ky. Log into your account and provide the necessary information for your personal profile and for your beneficiaries. For assistance in updating member details, call us at 745-7630 or email admin@pensions.ky. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.